In this video, I want to talk about where we're at in the markets right now and what we're looking at for the year ahead and things that you might think about for your retirement portfolio. Now, if we haven't met, my name is Liz Whittaberry. I'm a chartered financial analyst, and I'm the founder of Best Path Advisors in Colleyville, Texas, where I do comprehensive wealth management and retirement planning for my clients, which includes managing their portfolios. Now, 2025 was a good year in the market. We had the S&P 500 up 17.9%, the Dow Jones Industrial Average was up 14.9%, and the NASDAQ Composite was up 21.1%. Those are solid returns. And if we look over the last decade, it's been a decade of pretty good returns. In fact, the S&P 500 was down 2 out of those 10 years. And the last 3 years have been very good. Now, when we look at 2023, the S&P 500 was up 26.3%. In 2024, it was up 25%. And then in 2025, it was up 17.9%. Those are solid returns. But I get asked the question, the market's been up and up and up, and shouldn't it be going down soon? You know, the market has to come down at some point in time. Now, we've had some little, taking the steam off from time to time, but it is true that on average, the market is up 3 out of every 4 years, and it's down 1 out of every 4 years. But that's an average. It doesn't mean that the market is up 3 years in a row and then down, and then up 3 years in a row and down. It is not that neat and tidy. It's a lot more diverse than that. In fact, in the period from 1991 to 1999, the S&P 500 was up on an annual basis each of those 9 years. So the S&P 500 could be up again this year. The markets could be up. I'm expecting that they're going to be up. Now, we're early in the year. There's a lot that could happen, but just looking at the underlying economic data, while it's not as strong as it was, it's still good. And looking at the momentum in the market, that is still good. Combining those things, I think the market will be up this year. We're certainly facing a lot of geopolitical things. There are things that could happen that surprise us, that cause the market to pull back. But for now, I think we'll be up. So what are some things to think about for right now as we head into this year? Well, I always say you need to have your overall big plan. But if we're looking at some themes for this year, we should be happy that diversification is working better. For a long time, the U.S. markets were outperforming everything. And this last year, international outperformed. And I think it will outperform again this year. So that's providing some other places to invest that are still going to give you some good returns. Within the U.S., we had that period of time where it was all about the Mag 7. And the other 493 companies in the S&P 500 weren't contributing as much to what was, to the game, to what was going on. That is beginning to broaden out, which means that those other companies, those other 493 companies are doing a little bit better. That's a good thing too. We would like all 500 companies to be doing better so that your return is not based on just 7 companies. It's based on a much broader number of companies. So that is a positive. Now, on the negative side, stock valuations are very high. That means you're paying more for the earnings that you're paying for. When you buy company stock, you're buying their future activity that's going to generate earnings, that's then going to generate profit, that's going to then come back to you in the form of growth in the company's stock or dividends that are paid to you. When you're paying more, you're paying a higher price for those future earnings, then you're not getting as good a deal. And you've got to be very careful not to overpay. And so you got to be mindful of that and think about that as you're making any decisions within your portfolio. Part of what's going on right now is all of the money that's going into AI and building out everything that's related to AI. And there's billions of dollars being spent. Some of that's going to be good money. Some of that's going to be bad money. And you want to be mindful of where the money is going and which is good and which is bad so that you don't end up overpaying for something that turns out to be bad money. So pay attention to that. I think this next year will be volatile again. We certainly have a lot of headlines facing us. They're still trying to figure out what's going to happen with the tariffs, and there's all of this stuff that's happened in January so far. We've got a lot of political issues ahead of us. All of that noise creates big headlines that creates potentially some volatility. That's a reaction in the short term. I want you to stay focused on your long-term plan. Make sure that you have your plan set up. If you have a plan set up and you stay focused on the long-term plan, then what you should be doing is monitoring the situation, maybe adjusting your risk a little, but then allowing yourself to benefit in your long-term bucket from the volatility, while protecting the money in your short-term bucket from the volatility by having it invested very smartly for the type of money that it is and what you're going to do with it. The way that I manage client portfolios is I set up a short-term bucket that's going to be the stable account, the stable funds to provide income in the short term, a middle-term bucket that's going to be not as stable, but still not highly volatile, so we can replace that short-term bucket, and then the long-term bucket that's going to be all of the things that have a lot more volatility to gain the growth for the long term, to meet those future income goals, those future legacy goals, all the things that we want to have happen in the long term. And so if you have those buckets set up in that manner, then when things happen, you know that you've got your short-term bucket. You don't need to overreact. In fact, Peter Lynch, who's a famous fund manager, once said that he's seen people lose more money preparing for corrections than actually in the correction itself. So keep that in mind when you're putting your plan together, and put together a plan that you can carry through all the different types of periods that there might be ahead of you. As you're looking at your portfolio, make sure you've got high quality investments. Review the quality of those investments. Review the quality of the stocks, of the bonds, of the other investments that you hold. Higher quality investments have a little lower volatility when we go through any of these periods of time. And then review your diversification. Make sure you've got that well set up. You know, besides just the U.S. companies, in the U.S. markets, there's international markets, there's commodities, there's other areas that you can invest in. So you want to be thinking about that, talking with your advisor, and thinking about that. Now, that's something that I do with my clients, looking at all of the opportunities and where should the portfolio be invested in order to meet the goals and achieve the return needed and have the level of volatility that we want to have in each of the different buckets, and make sure that the income is there each year as they need it. So that's very important for retirement planning. Now, I'm planning to do a video like this each quarter to just give an update on where we're at and things to look at. So if you have any questions you'd like me to address, send me an email. And if you don't have an advisor helping you with your portfolio, and you're nearing retirement, you've got $2 million or more to invest, and you would like somebody to look at that and help you with that, let me know. Send me an email and I'd be happy to have a conversation. And I hope that you have the very best 2026 and you have a good plan for all of your retirement years.